Welcome to our end of the year 2015 commentary. While I normally cover the past quarter's activities, I would be remiss if I did not discuss the first 3 weeks of January. The start of this year has certainly been ugly, as I'm sure all of you are aware of. We're off to quite a negative start to 2016. In fact, this year's start is the worst start in the history of the market coming into a new year. So what's going on? Where are we going? What are we doing? And what should you do? The market continues to be weighted down by two factors, China and oil, with a small dab of uncertainty in the Fed monetary policy. I'm not going to talk too much about all of these factors as we've been commenting on them each week in our weekly commentary. However, it is our belief that, first of all, oil pricing will stabilize over the next month or so, which will bring some stabilization to the market along with it. While we are well aware of the downside created by having too much oil supply, and who would have thought this years ago, but what the market has not acknowledged at this point is the equal and opposite upside that provides many companies, and certainly us as consumers, of having lower cost in oil. There is a notion called consumer surplus, which means due to certain circumstances, there is a surplus in cash flow created for consumers, almost like a tax savings. Cheaper oil is certainly providing this to us, as is exponential technology. We also believe China will stabilize, though it may take a bit longer, as they will need to tweak their fiscal and monetary policy. Again, we do not see this as being a long-term detriment to investing in the broad market. Finally, we believe domestic economic indicators will continue to be positive, but probably not positive enough to temper short-term fears until we do see some stabilization in the problem areas. In our opinion, the worst we would expect to see is a 20% downside to the market, which is already down over 10%. Frankly, I would be surprised if it hit this level, but momentum certainly is negative at this point. Even if the downside for stocks may be 20%, we actually see more upside potential than downside over the course of 2016. 20% is the definition of a bear market. Bear markets are usually accompanied by recessions, which few experts believe a recession is likely for the U.S. in 2016. As mentioned last quarter, pullbacks, which is defined as 10%, and bear markets, defined as 20%, are a very natural part of market cycles. So what are we doing? By and large, we have left all of our portfolios intact. We made a slight adjustment to take some risk off the table in our more moderately managed portfolio, Advance and Protect, and also made a tactical adjustment in our more aggressive portfolio, Dynamic Growth. If we believe things have much more downside, it is possible we would continue to scale down on a few positions while at the same time we're looking for an opportunity to get slightly more aggressive within our more growth-oriented portfolios. You may recall we took 10% out of the equities in our portfolio last April at a market high, and we would like to put this money back to work during this downturn. So what should you do? Well, here comes the pep talk. You should do nothing. You should not be watching the markets on TV, checking the balances online, and some of you probably should not even open your statements. This will drive yourself crazy. You pay us to be driven crazy, and believe me, this is where we earn our pay. Having been through dozens of downturns in my 25-year career, I believe we know the solutions, though it certainly does not make things any easier. I do want you to feel free to call our office if you have questions or if you would like to discuss your personal situation. However, I'm confident we have put a proper strategic plan in place for you, and I'm also confident things will ultimately work out as expected. I will focus minor attention to Q4 of 2015, as I'm sure most of you are much more interested in today and tomorrow as compared to last quarter. But as ugly as 2016 has been thus far, there was really no great news for 2015 as well. A couple of articles from a weekly investment newspaper I receive are titled, "World's Richest People Lost $19 billion in 2015. From the same newsletter, "The year that stocks, bonds, and cash failed to thrive." And finally, from still the same newsletter, "Outlook 2016, Optimism Prevails." The year started out positive for 2015, but around April it turned negative, and although we had a bit of a turnaround in the fourth quarter of this past year that is, we were never able to get back to the highs that we enjoyed in early 2015. For the quarter, capital markets rebounded as U.S. equity was up 6.1%, putting the Russell 3000 index just above break even for the entire year at a positive 0.5% return. Overseas international markets underperformed the U.S. while posting a positive 4.7% for the fourth quarter, but a negative 0.4% for the year. The fourth quarter marked the Fed's first rate hike since 2006, significant because monetary policy finally turned to one of tightening. The hike was evidence of the Fed's confidence about the status of and the prospects for the U.S. economy. It'll be interesting to see where we go from here considering the start to 2016. So for 2015, U.S. equity styles were all positive for the quarter but mixed for the year, with the U.S. large, mid, and small value posting losses of a negative 1.4%, negative 3.8%, and negative 7.1% for the year. From a sector standpoint, it was a mixed bag as well, with consumer discretionary leading the way up 10.1%, while energy was down 21.1% and materials were down 8.4%. As already mentioned, international struggled as well, with emerging markets posting a loss of 14.6% for the year. Fixed income was relatively flat for the year, with the aggregate bond market up 0.5%, and high yield bonds were the worst performing at a loss of 4.5%. This is something that I'm not going to focus the camera on it, but it's a kaleidoscope that we put together on a quarterly basis. And what it does is it shows what sectors are doing well and are not doing well in order. But it provides a quick rundown of the major asset categories for 2015, and it reads like this. Russell 1000 Growth was the top performing sector, up 5.67%, while the balanced index was up 0.59%, aggregate bond was up 0.55%, the international index was down 0.39%, Russell 2000 Growth was down 1.39%, the Russell 1000 Value was down 3.83%, and finally the Russell 2000 Value was down 7.47%. So again, in summary, a very disappointing year for 2015 across the board. In closing, given the pullback we've already experienced in 2016, I wanted to provide you with an interesting statistic. Over the past 36 years, the average intra-year decline was 14.2% per year. In other words, if we were to look at the worst period over each and every year for the last 36 years and average it out, there would be an average drop in the market during the year of 14.2%. Yet the market finished positive 75% of the time, or 27 out of the last 36 years. I again invite you to contact us with any questions, thoughts, or concerns, and thank you for your continued trust and confidence.